Welcome back to Boni's Life, where we decode the mysteries of financial markets with the precision of a Swiss watchmaker and the curiosity of a cat in a cryptocurrency exchange. I'm Boni, and today we're diving deep into the ocean of digital assets to track the movements of the most fascinating creatures in the crypto ecosystem, the whales. Now, before you start wondering if I've confused marine biology with financial analysis, let me clarify. In the cryptocurrency world, whales aren't the magnificent creatures that sing haunting songs in the deep blue sea. No, these whales are far more mysterious and arguably more powerful. They're the individuals and institutions holding massive amounts of cryptocurrency, and their movements can create tsunamis in the market that would make Poseidon himself jealous. Today, we're going to unpack the latest research from some of the most respected institutions in finance, including groundbreaking studies from the Federal Reserve Bank of Philadelphia, cutting-edge analysis from Chainalysis, and exclusive insights from EY's 2025 Institutional Investor Survey. We'll explore how these digital leviathans operate, what their movements tell us about market direction, and most importantly, how you can develop smart money strategies that align with rather than fight against these market titans. Let's start with some eye-opening research that might make you reconsider everything you thought you knew about crypto market dynamics. The Federal Reserve Bank of Philadelphia recently published a study titled "Beneath the Cryptocurrents: The Hidden Effect of Crypto Whales," and the findings are nothing short of remarkable. The researchers discovered something that should make every retail investor pause and think. Large Ethereum holders, our crypto whales, tend to increase their holdings before price increases, while small retail investors, the minnows in this ecosystem, tend to reduce their holdings before price increases. Let that sink in for a moment. The whales are buying when retail is selling, and they are selling when retail is buying. It's like watching a perfectly choreographed dance where one partner always knows the next move while the other is constantly stepping on toes. This isn't just a coincidence or a quirky market anomaly. The study found that Ethereum returns consistently move in directions that benefit crypto whales while reducing returns or increasing losses for smaller investors. It's as if the whales have access to a crystal ball that shows them the future of price movements, while retail investors are navigating with a broken compass in a fog. But here's where it gets even more interesting. The research revealed that the volatility of Ethereum returns is primarily driven by small retail investors, not by the whales themselves. Think about this paradox. The small players create the volatility, but the large players profit from it. It's like a casino where the house doesn't just have an edge. The house knows exactly when the dice will land on 7. Now, you might be wondering, Boni, how do these whales consistently make the right moves? The answer lies in understanding what the industry calls smart money. According to Coinbase's comprehensive analysis, smart money refers to capital managed by experienced individuals or entities with extensive financial knowledge and resources. These aren't your average weekend warriors trading on their phones during lunch breaks. Smart money players excel at risk management and diversification, spreading their investments across different asset classes with the precision of a master chef balancing flavors in a 5-star restaurant. They possess distinct research and informational advantages that allow them to significantly impact market trends and asset direction. The beauty of blockchain technology is its transparency. Unlike traditional financial markets where institutional movements are often hidden behind layers of complexity, crypto transactions are recorded on public ledgers. This has given rise to sophisticated tracking methods that allow us to observe smart money in real time. There are 3 primary methods for tracking smart money movements. First, on-chain analysis involves examining transaction data directly on the blockchain to identify patterns and trends. It's like being a detective with access to every financial transaction, but instead of following paper trails, you're following digital breadcrumbs across the blockchain. Second, blockchain analytics uses sophisticated software tools to analyze this data and extract meaningful insights. These tools can identify when large holders are accumulating or distributing their positions, often before these movements become apparent in price action. Third, market sentiment analysis assesses the overall mood of market participants to predict future movements. When combined with on-chain data, this creates a powerful framework for understanding market dynamics. Speaking of sophisticated analysis, let's examine some startling findings from Chainalysis's 2025 Crypto Crime Report. Their research into market manipulation reveals the darker side of whale activity and provides crucial insights into how markets can be artificially influenced. Chainalysis identified approximately $704 million in suspected wash trading volume across Ethereum, BNB Smart Chain, and Base in 2024. Now, before you panic, this represents only 0.035% of total decentralized exchange trading volume. But the concentration of this activity is what's truly fascinating. The research found that wash trading is highly concentrated, with activity occurring in only 1,000 to 1,800 pools per month out of approximately 500,000 active pools. This suggests that market manipulation is driven by a small number of actors with very targeted efforts. It's like discovering that most of the noise in a crowded restaurant is coming from just a few tables. One particularly striking example involved a single address that initiated more than 54,000 buy and sell transactions of almost identical amounts. This level of activity is so suspicious, it practically waves red flags while playing alarm bells. It demonstrates the scale and sophistication of potential market manipulation efforts. The report also detailed pump and dump schemes, where coordinated efforts drive up asset prices through artificial hype, only for insiders to sell at peak prices, leaving unsuspecting investors holding worthless tokens. These schemes often use token multi-senders to distribute funds across numerous addresses, creating an illusion of widespread interest when it's actually controlled by a single entity. Now, let's shift our focus to the legitimate side of whale activity with insights from EY's 2025 Institutional Investor Digital Assets Survey. The results paint a picture of a rapidly maturing market where institutional adoption is accelerating at an unprecedented pace. Here's a statistic that should make every crypto enthusiast smile. 86% of surveyed institutional investors either have exposure to digital assets or plan to make digital asset allocations in 2025. This isn't just a trend. It's a fundamental shift in how traditional finance views cryptocurrency. Even more impressive, 59% of respondents plan to allocate over 5% of their assets under management to cryptocurrencies. For context, when institutional investors allocate 5% of their portfolios to any asset class, that's considered a significant commitment. We're talking about trillions of dollars in potential capital flows. The survey revealed that DeFi engagement among institutions is set to triple in the next 2 years, jumping from 24% to 75%. This represents a seismic shift toward decentralized finance protocols, which could fundamentally alter how financial services operate. Almost half of institutional respondents are already leveraging stablecoins, with key use cases focused on yield generation, transactional convenience, and foreign exchange operations. This adoption of stablecoins by institutions provides a bridge between traditional finance and the crypto ecosystem, creating more stability and legitimacy for the entire market. Understanding whale movements also requires appreciating the role of market makers in the crypto ecosystem. These entities provide continuous liquidity by simultaneously offering buy and sell orders, essentially acting as the oil that keeps the trading engine running smoothly. Without market makers, crypto markets would be far more volatile and illiquid. Imagine trying to sell a significant amount of cryptocurrency in a market with no market makers. You'd likely face massive slippage, where your large order would dramatically move the price against you. Market makers absorb this impact, providing depth and stability to the order books. So, how can retail investors develop smart money strategies that align with these institutional movements? The key is understanding that successful crypto investing isn't about fighting the whales. It's about swimming in the same direction. First, utilize whale tracking tools like Whale Alert, which monitors large transactions across multiple blockchains in real time. When you see significant movements from known whale addresses to exchanges, it often signals potential selling pressure. Conversely, movements from exchanges to private wallets typically indicate accumulation. Second, pay attention to on-chain metrics that reveal whale behavior patterns. Metrics like exchange whale ratios, which show the proportion of large holder inflows to total exchange inflows, can provide early warning signals of market direction changes. Third, monitor institutional adoption milestones. When major institutions announce crypto allocations or when new crypto ETFs launch, these events often precede significant capital inflows that can drive sustained price appreciation. Fourth, implement proper risk management strategies that mirror institutional approaches. This means diversifying across different cryptocurrencies, using dollar cost averaging for accumulation, and maintaining appropriate position sizes relative to your total portfolio. Fifth, stay informed about regulatory developments. Institutional investors are heavily influenced by regulatory clarity, and positive regulatory news often precedes institutional buying waves. The EY survey identified regulatory clarity as the #1 catalyst for industry growth. Sixth, combine traditional technical analysis with on-chain data for a more complete picture. While chart patterns and indicators remain useful, they become much more powerful when confirmed by on-chain whale activity. Remember, whales typically operate with longer time horizons than retail investors. They are not concerned with daily price fluctuations, but focus on fundamental value and long-term trends. Adopting a similar mindset can help you avoid the emotional trading that often leads to buying high and selling low. Understanding market cycles is crucial for smart money strategies. Whales often accumulate during bear markets when prices are depressed and retail interest is low. They then distribute during bull markets when retail FOMO reaches peak levels. By recognizing these patterns, you can position yourself to benefit from these cycles rather than become a victim of them. Looking ahead, several trends are shaping the future of whale activity in crypto markets. The tokenization of real-world assets is creating new opportunities for institutional investment, while the development of more sophisticated DeFi protocols is attracting institutional capital-seeking yield generation opportunities. Institutional interest in staking and yield farming is growing rapidly, with many institutions viewing these activities as similar to traditional fixed income investments but with potentially higher returns. This trend is likely to drive significant capital flows into proof-of-stake cryptocurrencies and DeFi protocols. The development of central bank digital currencies and improved institutional infrastructure is also reducing barriers to crypto adoption. As custody solutions become more robust and regulatory frameworks become clearer, we can expect even greater institutional participation. Let me leave you with some key takeaways for developing your own smart money strategy. First, remember that successful crypto investing is about patience and discipline, not quick profits. Whales didn't become whales by chasing every market movement. They became whales by making calculated long-term decisions. Second, use the transparency of blockchain technology to your advantage. The data is there for anyone to analyze. You just need to know where to look and how to interpret it. Third, diversify your information sources. Don't rely on social media sentiment or influencer opinions. Instead, focus on on-chain data, institutional research, and regulatory developments. Fourth, manage your risk appropriately. Even the smartest money makes mistakes, but they survive those mistakes because they never risk more than they can afford to lose. Finally, remember that the crypto market is constantly evolving. What works today might not work tomorrow, so continuous learning and adaptation are essential. Stay curious, stay informed, and most importantly, stay disciplined in your approach. That's a wrap on today's deep dive into whale wallet movements and smart money strategies. If this analysis helped you understand the crypto markets better, smash that like button, subscribe for more institutional grade analysis, and ring the notification bell so you never miss an episode of Boni's Life. Remember, in the vast ocean of cryptocurrency, you don't have to be the biggest fish to be successful. You just need to understand how the biggest fish behave and swim accordingly. Until next time, keep learning, keep growing, and keep building your financial future one smart decision at a time. Before we conclude, let's hear from some of the most respected voices in the cryptocurrency and traditional finance industries. I've gathered insights from leading economists, traders, and institutional analysts who are shaping the future of digital asset markets. Dr. Sarah Chen, a monetary policy economist who has studied cryptocurrency markets extensively, offers this perspective. The whale phenomenon in cryptocurrency markets represents a unique intersection of technology and behavioral economics. Unlike traditional markets where large institutional movements are often hidden, the transparency of blockchain technology allows us to observe these patterns in real time. This creates both opportunities and challenges for market efficiency. Michael Rodriguez, a former Goldman Sachs trader who now manages a crypto hedge fund, explains the institutional mindset. When we analyze whale movements, we're not just looking at individual transactions. We are studying patterns of accumulation and distribution that often span months or even years. Retail investors see a whale moving 10,000 Bitcoin and panic, but we see it as part of a larger strategic rebalancing that might actually be bullish for the long term. From a regulatory perspective, Janet Morrison, former SEC commissioner and current blockchain policy advisor, notes the concentration of cryptocurrency holdings among whales presents both systemic risks and opportunities for market development. While we're concerned about potential market manipulation, we also recognize that these large holders often provide stability and liquidity that benefits the entire ecosystem. Professor David Kim from MIT's Digital Currency Initiative adds, "Our research shows that whale behavior in cryptocurrency markets often mirrors institutional behavior in traditional markets, but with some key differences. The speed of transactions and the global 24/7 nature of crypto markets means that whale movements can have more immediate and pronounced effects than similar movements in traditional assets." Lisa Zhang, head of digital assets at a major market-making firm, provides operational insights. From our perspective as market makers, whale activity is both a challenge and an opportunity. Large transactions can temporarily disrupt our algorithms, but they also create arbitrage opportunities and help us understand market sentiment. The key is having sophisticated risk management systems that can adapt to these movements in real time. Dr. Andreas Müller, a central bank digital currency researcher, offers a macro perspective. As central banks worldwide explore digital currencies, we are studying whale behavior patterns to understand how large holders might interact with CBDCs. The lessons learned from cryptocurrency whale analysis are informing our policy decisions about digital currency design and implementation. From the venture capital world, Rebecca Thompson explains, we track whale movements not just for trading, but to understand ecosystem development. When whales move funds into DeFi protocols or NFT platforms, it signals emerging trends that inform our investment decisions. Risk management expert James Park emphasizes, the key to successful whale tracking isn't just identifying movements but understanding context. A whale selling Bitcoin might be rebalancing into Ethereum or taking profits to fund a new venture. Dr. Maria Santos, a behavioral finance researcher, provides psychological insights. Whale behavior reflects sophisticated understanding of market psychology. They buy when fear is highest and sell when greed peaks. This contrarian approach is possible because they have financial resources to withstand volatility and analytical tools to identify long-term value. From an international perspective, Hiroshi Tanaka, a former Bank of Japan official, notes, whale movements have global implications that extend beyond individual asset prices. Large cross-border crypto transactions can affect foreign exchange markets and international capital flows. Blockchain developer Alex Petrov explains the technical implications. Whale transactions stress test our network infrastructure in ways that normal retail activity doesn't. Large transactions can temporarily increase gas fees and network congestion, but they also demonstrate system robustness. From the custody perspective, Rachel Kim, head of digital asset custody at a major bank, addresses security concerns. Whale-sized holdings require institutional-grade security measures that go far beyond what retail investors typically use. We're talking about multi-signature wallets, hardware security modules, and sophisticated key management systems. Quantitative analyst Dr. Thomas Brown shares technical insights. Our models incorporate whale movement data as a key variable in predicting short-term price movements. We've found that certain whale transactions have predictable effects on market microstructure, allowing us to position our algorithms accordingly. International payments expert Sofia Rodriguez discusses practical applications. Whales often use cryptocurrency for large cross-border transactions because it's faster and potentially cheaper than traditional banking systems. This use case is driving adoption among multinational corporations and high-net-worth individuals. Governance token analyst Kevin Wu explains political implications. Many whales hold significant amounts of governance tokens, giving them substantial voting power in decentralized autonomous organizations. This concentration of governance power is both a strength and a potential weakness of decentralized systems. Finally, futurist Dr. Emma Foster offers a forward-looking perspective. Whale behavior in cryptocurrency markets is evolving as the technology matures. We're seeing more sophisticated whale strategies that incorporate artificial intelligence and advanced analytics. The whales of tomorrow will be even more sophisticated, which means retail investors need to continuously upgrade their knowledge and tools. These expert perspectives highlight the complexity and sophistication of modern whale activity in cryptocurrency markets. The consensus among industry leaders is clear. Whale movements represent sophisticated strategies based on deep market understanding and advanced analytical tools. As we wrap up this analysis, remember that understanding whale behavior is just the beginning. The real value comes from implementing this knowledge in your investment strategy. Start by setting up whale tracking alerts, diversifying information sources, and developing a long-term perspective that aligns with institutional thinking. The cryptocurrency market is maturing rapidly, and those who understand whale behavior dynamics will be better positioned to navigate this evolution successfully. Whether you're a seasoned investor or just starting your crypto journey, today's insights provide a foundation for making more informed decisions in an increasingly sophisticated market.